You know something is truly wrong when a used car is an appreciating asset. You came here for the truth, so let me unveil that for you. It's true. Right now, today, used cars are accelerating so fast, it's mind-boggling. The first thing I want to talk about is consumers. I'm going to look into many factors around it. Number two, China, but not specifically what's happening with the economy today. I want to talk about the tech stocks. And number three, we're going to look at real estate on the commercial side especially. But of course, I've got a lot of information surrounding this. There's a lot of detail in this video, so let's begin. So let's start by taking a look at the consumer sentiment. You can see that it has declined from its peak, but why is this the case? Of course, you're going to see the direct effects of the stimulus going into all of these different statistics. If there's a lot of stimulus, of course, things are going to look fantastic. If there's less stimulus, you start to see that, and consumer sentiment has to be one of those pieces. Now check this out. There's two charts. This is the US retail sales excluding autos month over month, 1.3, okay? And then you look at US retail sales, 0.6. So you know specifically what's been happening with cars, and it's truly unbelievable. They are becoming such a big part of these different statistics, how they're being moved and manipulated in the way that they are. I don't mean necessarily manipulated as in, this is something being done behind the scenes. No, you're just seeing that one factor is contributing to a really big portion of this. Red hot US economy expected to cool from here. Growth likely to hit a high point in the second quarter and will slow as the boost from the fiscal stimulus and the reopenings fade. Okay, so this is what I was talking about a moment ago. And you can see it's obviously having a direct impact on many industries, businesses. They require people to come in. Now you've got the reopening of restaurants. You've got different things that are happening that are obviously positive in the long term, at least. The US economy, 2021's growth surge likely peaked in the spring. They expect slower but still strong expansion into next year. I don't know what these economists are usually generally 180 degrees wrong, but certainly we do have this real, true reasons why the economy could in fact be slower and continue to slow down as long as we don't see new stimulus. If there's new stimulus, you pump it in again. You take another shot of caffeine again. You have a little bit of espresso. You have a double espresso, doppio, and you're pumping it up. But how long can you do that? Do you have 4 espressos? Do you have 10 espressos? Do you have 50 espressos? Your body can't handle that, okay? All right. More coffee science with the GPS guy. All right. Widespread businesses reopenings and a bunch of other factors are basically being one of the main drivers of what's happening with consumer spending. We know that. Before, people couldn't go to the movie theater. They couldn't go to the restaurants. So you couldn't spend the money there. It was being saved or it was being spent on renovations in their home and so on. We saw all of that. We've moved into a more moderate phase of expansion. We are past the peak for growth, but that doesn't mean something more sinister is going on here and then we're poised to drop off sharply. We don't know what's going to happen, but I can tell you that is directly connected to what we're seeing with the stimulus. That's all I wanted to say. Now, speaking of stimulus, check this out. Schools are turning stimulus funds into teacher bonuses. Districts and states pay thank you bonuses to lift morale to retain teachers. Some say it's a bad idea. I wanted to know what you think of this. Stimulus money, so taxpayer money, being used to give teachers bonuses. What do you think? Let me know. I don't have a comment on it. I want to know what you think. Selling your used car, you could turn a profit. If you had asked anybody, let's say 2019 and prior, every year prior to 2019, since the existence of these cars, a used car making a profit, maybe a collectible, and maybe if it's owned by a certain particular person, it has a unique value. But we're talking about generic vehicles here. Normally a depreciating asset, some used cars are worth more now than they we're new. It just seems like we're in fantasy land. It's very true. And they basically just talk about, the details of that. I don't think we need to get into that. But anyway, what have you seen? A lot of people have been commenting on it. I think it's obviously there's going to be pockets everywhere. So your experience might be different than mine and your neighbors and so on. But certainly we should be aware that this is happening, in a broad sense everywhere. Cathie Wood is selling shares in Chinese tech companies. And some investors particularly have seen that this has been a time to buy. The Crane Share CSI China Internet ETF saw record inflows this week. Wood told investors from a valuation point of view, these stocks have come down, and again, from a valuation point of view, probably will remain down. So this is Cathie Wood, who obviously a lot of people are interested in now all of a sudden, but, I don't know what to necessarily take from it, but I wanted to show you just what they're saying anyway. Record cash floods into China's tech ETF as Cathie Wood keeps selling. KWEB is the ticker that we're talking about. Sees 2 record single-day inflows after Chinese tech hit. So you saw what happened with all these different companies simply because they're starting to crack down on the IPOs and they're putting a lot of pressure on them. I'll talk about more in a second. ARK is offloading Chinese tech shares, and that could be a buy signal. Interesting that they're using Cathie Wood as being a contrarian indicator, as they mentioned here. I have it here somewhere. With Wood herself warning that there's a valuation reset afoot. If anything, ARK's exit may have acted as a contrarian buy signal to some. Between all the call buying last Friday and all the inflows this week, it certainly seems like investors are trying to pick a bottom. Maybe Cathie Wood's getting out was the final contra sentiment indicator those investors needed. Look at the chart. I'll show you this right here. Record cash inflows into KWEB after the sell-off. There's no denying that. Look at the massive inflows in there. Now, does that mean that it's a buy because other people started to buy? Well, not necessarily. You got to look at the technical indicators and see what's happening. Fundamentally, there's obviously issues because there's going to be more crackdowns. They've been doing this for a while. It's not going to stop anytime soon. However, this is a little bit different for many reasons because these are already established and so on. But I just wanted to bring it to you. I think it's important. China signals entered the $2 trillion US stock listing juggernaut. China will force most firms to seek approval for foreign IPOs. They're putting additional pressure. But if you want to look at it from the positive light here, if they actually do move through that, they get approved, and then they can go on to the US and do their business there, then you know that you don't have to worry as much because they've gone through the scrutiny already. More than 400 Chinese companies have gone public in the US. For 2 decades, Chinese tech firms have flocked to the US stock market, drawn by a friendly regulatory environment and a vast pool of capital eager to invest in one of the world's fastest growing economies. Now, the juggernaut behind hundreds of companies worth $2 trillion appears stopped in its tracks. So this is also, an issue with cryptos and so on as they crack down on all of the mining, and that, in my opinion, is actually a positive thing, but in short term, it's probably not. It's unlikely that there will be any US listed Chinese companies in 5 to 10 years, other than perhaps a few big ones with secondary listings. So I don't know what's going to happen. It seems like everybody knows what's going to happen in the future, but I just think it's interesting to see, the dynamics between China and the US. I think there's a lot going on. Home and away, Chinese shares fare far better in the US because there's so much money going into the US, right? There's way more cash flooding into the US than any other market around the world. And you see the difference there. The black line, obviously, being the S&P BNY Mellon China Select ADR Index. Comparing that to the Shanghai Composite Index, big difference. I would note, however, that there are many more swings, particularly over the last 2 years, but those who had been able to hang on through this period were clearly going to be beneficiaries in that case. Now, this brings me to Morgan Stanley and what they had to say. They talk about, near term, that things are looking actually rather bullish for the economy. Now, there's a lot of distortions here, but I wanted to show you this specifically because I remember when this was read back in, it's hard to tell in here. I'm assuming we're looking at, 2019 timeframe, somewhere around there, 2018, 2019. I showed you this chart. And I had a lot of people saying, no way, there's nothing going on, you're bearish, and all this nonsense. This is an extremely accurate indicator, US cycle indicator out of Morgan Stanley. It doesn't tell you what's going to happen in the future. It's putting it, point in time right now. And it's just showing you that it's heading upward. Now there's, trillions in stimulus and the quantitative easing and so on. So we don't know. But at least at this moment, things are coming up. And that's true, because if you look at where we were a year ago, I would agree with that. Anybody would agree with that. But it's using a crutch to stay alive. That cannot persist forever. Number one, as stimulus fades, the economy will fall. Number two, at this time, today, markets have priced in absolute perfection. If there's any small slip up, there's going to be an immediate volatile reaction. Number three, there's no denying it by any metric. You will look at and see that the market, the stock markets, and all financial markets really have hit peak euphoria. Couple quick notes right here. Mortgage refinance fee dropped by regulator, lowering costs for borrowers. Fannie Mae and Freddie Mac are dropping a fee on mortgage refinances that was instituted previously. They were charging lenders 50 basis point fees for all loans that they delivered to two mortgage giants. That was designed to cover the losses projected as a result of what happened in 2020. They're dropping that fee. This is, of course, going to make things a little bit easier, and they're trying to make this happen because they need this boom to continue on forever. This was actually from last year, but I wanted to show it to you right now. Amazon leased warehouse up for sale as California market thaws. Now, this is June of 2020 last year, but I just found it interesting because this particular company is essentially trying to sell the property that's being leased out by Amazon. They're saying it's a cap rate of 4%. And I just, you've got a tenant that's probably not going to be leaving there for a long time. Very, very solid. They're going to be paying their bills, and yet they're selling. So I wonder what's happening with these, they're talking about LDK Ventures, but you'll see many of these where they've encountered problems and they need to liquidate because commercial real estate in general is doing very poorly. So I don't know what's going on the commercial side, but I see definite weakness. This one here is probably some serious strength. Of course, you don't know what's going on with the regulations, the bills they got to pay on their end, but I just think in general, used car frenzy makes for record prices and cutthroat sales floors. A rush of buyers are enjoying loosening restrictions has added to the already strong demand, letting dealers command high prices as they scramble for more inventory. Again, quite frankly, what I've seen here, a lot of people don't want to take the, as we move into 2020, I was noticing a lot of people, they weren't taking the mass transit and instead they were buying used cars. So the demand for them started to surge. At the same time, you've got the problems with the chips and things, we're trying on the new car development that was lagging behind. Supply chain issues, shortages, there's so many different things that are happening, a million different things. And of course, it's being reflected in used cars right now. Just very unusual. We haven't seen something like that. Treasury Secretary Janet Yellen, your favorite and mine, to discuss stablecoins with regulators next week. So this, I think there's going to be more regulation, you know that. They can't stop it, but I do think that they're going to try to squeeze everything they can out of this. They're going to do everything they can to make it more difficult for people to get into cryptos, and of course, exchange between fiat and cryptos. I think that's the future, what they're trying to accomplish anyway. When many people think of the student debt crisis, they think of jaw-dropping six-figure debt totals. But many of those big numbers end up being outliers, or they're grad students who have accumulated debt based on continuing their education. Looking at this here, today's Americans collectively owe more than $1.7 trillion in student debt. It's crazy. Brookings estimates that while just 25% of student loan borrowers went to graduate school, these students hold about half of all outstanding debt. You can see what happens with the type of degree. Now, all of that to simply tell you, I do think the education system has to change. It's too expensive, and many people come out with a lot of debt and not a good paying job. That is unsustainable, and it needs to change. That's my opinion on it, and I want to know what you think. Put it in the comment section below. Have you already joined the Insiders? If not, I would highly recommend doing so, because that's my way to get to you and you to get to me. I will email you the video of the day. Okay, so you definitely want to get on there. I'll put a card up here, or just go to themoneygps.com and you can get on. Actually, have you already been on the live streams? I'm now doing live streams. I'm going to try to do so every single day. It's going to be at 6 p.m. Pacific time and 9 p.m. Eastern time. If you can get on, I would appreciate it. As I record this video, we did 1 hour. 1 hour. It was supposed to be half an hour. I ended up going long, 1 hour. It's fantastic. Hope you all join. I show you what's going on with the stock market. I actually dive deep into it just for a brief period, but I tell you what you need to know, talk about the connection with the economy, and then it's all Q&A after that, okay? So I'll try to make that a habit. Get on there. If you haven't already, you got to give the video a thumbs up. You've got to subscribe to the channel. It's crazy how many people watch the videos and are not subscribed. Hit that subscribe button. I know that you think, well, I don't need to because I'll come back. Don't. Hit that subscribe button. Be one of those. We're going to supercharge this thing all the way to 300,000 subscribers and beyond. Be part of that. I really hope you do. That's all. If you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.